How does selling a home affect my taxes? Have you ever wondered how selling your home impacts your taxes? It can be a bit tricky, but understanding the basics can help you navigate this important financial decision. When you sell a home, the tax implications depend on whether it was your primary residence or an investment property, how long you owned it, and how much profit you made from the sale. If you are selling your main home, you might benefit from a capital gains exclusion. The Internal Revenue Service allows you to exclude up to $250,000 of profit if you are single. If you are married and filing jointly, that exclusion increases to $500,000. To qualify, you must have lived in the home as your primary residence for at least 2 of the 5 years before selling. This can significantly reduce or even eliminate the capital gains tax you may owe. Now, if the property you are selling was an investment rather than your primary residence, the rules change. In this case, selling the property will generally trigger capital gains taxes on the profit you made. If you own the property for less than 1 year, you would face short-term capital gains taxes, which are taxed at your ordinary income tax rate. This rate can be as high as 37%. However, if you held the property for more than 1 year, you qualify for long-term capital gains rates, which are typically lower, ranging from 0% to 20%, depending on your income level. For investment properties, you may have claimed depreciation deductions during ownership. When you sell, the Internal Revenue Service requires you to recapture this depreciation. This means the amount you deducted will be taxed at a special rate, which can be up to 25%. This can increase your tax liability when you sell. Real estate investors have additional tax considerations. You can reduce your taxable income through various deductions, such as mortgage interest, property taxes, repairs, and management fees. The Tax Cuts and Jobs Act allows many investors to deduct up to 20% of qualified business income from rental activities, which can further lower your taxable income. If you plan to sell an investment property, consider holding it for more than 1 year to qualify for long-term capital gains rates. You might also want to look into strategies like a Section 1031 exchange, which allows you to defer capital gains taxes by reinvesting the proceeds into another property. For homeowners, meeting the residency and ownership tests before selling can help you maximize the capital gains exclusion. Keeping detailed records of any improvements made to the property and the depreciation taken can help you accurately calculate your gain and any depreciation recapture. In summary, selling a home affects your taxes mainly through capital gains taxes. These taxes vary based on whether the property was your primary residence or an investment, how long you owned it, and your filing status. Understanding these factors is essential for effective tax planning when selling real estate.